I will start with a brief introduction of myself, and then subsequently I will introduce our very special guest, Mr. Pawan Singal, and then we will begin the session. So I am Jatin Tehri. I qualified in 2005, and I started my career with one of the Big Four consulting firm, and then subsequently I also worked in industry for 3 years, and then I started my practice. In my practice, I do both sides, audit and assurance, and the advisory piece as well. And on the advisory side, we do a lot of merger acquisition, valuations, due diligence, fraud investigations, and IPO advisory as well. And when I say all these things, IBC definitely for last few years has also become very integral part of this entire piece, which includes fraud investigations as well, transaction audits, and then preparing of balance sheet for the special purposes. And that's how it is. And for this specific purpose, we have very special guest today with us, Mr. Pawan Singal. I'll just give a brief introduction about him. So Mr. Singal is a chartered accountant, company secretary, and insolvency professional. He has more than 25 years of collective experience of industry as well as of the practice, which is into insolvency practice. And he's also SRCC alumni. If I give you a very brief about him is anything related to any technical piece, I mean, he's the person I always look forward to and seek his advice. So our today's topic is related to the insolvency law, and we definitely be talking about the opportunity for chartered accountants in the insolvency practice, as well as how we can handle the financial statements before the CIRP process and after the CIRP process, which is the crucial thing as of today. Because whenever we are preparing the financial statements and we can see that there is some sort of a stress in the company, it becomes very difficult to take calls and do the judgment. And that's where it is when the company goes to insolvency, we get trapped and we don't know how to handle that kind of a situation as an auditor. And when the insolvency process gets completed, we are again, as professional, in most of the cases, clueless how to be presenting the financial statements and all other things. So that's why we have Mr. Singal, who comes with a wealth of experience. So over to you, sir. I mean, I have tried to give a brief introduction about you. If you want to add, please, sir, most welcome to today's session.
Thank you, Jatin ji. And I respected Chopra ji, Vijay, and my all dear friends who have spared their time to attend this webinar. I am not competent to discuss the nitty-gritty of the Companies Act or the balance sheet. Mr. Chopra ji is an expert, so we are not able to give anything new to the subject. But I will give my perspective from the as a resolution professional, how we see the balance sheet, what queries we normally raise in the audited financial statements, and how we assess the stress, and how the new chartered accountant can, on the basis of knowledge, can expand their practices in the stress companies audit and post resolution of the stress after the approval of the resolution plan by the NCLT. Now, first beginning, the IBC Act was enacted in 2016. Before that, there was BIFR and other acts, SURFACE, which were prevalent to resolve the stress in the companies. But there was no effective mechanism. Cases go on lingering for years together, and emphasis was on the recovery and not resolution of the insolvency. Now, under the IBC Act, the emphasis is more on the resolution, rehabilitation, and revitalization of the corporates. Under the insolvency process, the resolution plans are submitted and new management take over the company and then take the responsibility to turn around the corporate. Definitely, when you submit the resolution plan, he worked out viability of the project, assess everything, and take the loan and liability to the extent which he thinks will make the project viable. So there's no doubt there are haircuts. And Then company he can take by invest their own money, induct further funds, bring in the working capital also, and then rehabilitate and revitalize the project. That's the entire concept of IPC. But now, from an auditor's perspectives, now you might have heard in today's environments, the CAs are scared in getting the balance sheet signed. Why so? Most of the situation, except few listed companies where there are other issues where the auditors are afraid in signing the balance sheet. But in non-listed companies, the major issues which CA faces are the stress in the company and how to deal with the stress while auditing or doing the qualification or disclosures in the balance sheet. Let's first see when the balance sheet comes, what are the symptoms of the stress? Nupur, jara slide ko share karo. Symptoms of the stress in the company. We'll show some slides, what the show, then simultaneously I will show the one balance sheet which we have received recently, and then we'll show how the stats are reflected in the balance sheet. First, let's understand what the symptoms of the stress in the company. Next slide, karo. Symptoms of the stress in the company. नूपुर आके चलाओ इसको. Next slide. Next slide. Yes, the symptoms of stress in a company. Now, there are many symptoms. Some of the things we can state as under continuous losses in the company, substantial erosion of net worth, non-ability of the sufficient working capital, low turnover of debtors and inventory, arrears or discontinuation of dividend in the dividend-paying company, inability to pay creditors on due dates, inability to comply with the terms of the loan agreements, change from credit to cash on delivery transaction with suppliers. Suppose you are buying the material on the credit, but suddenly if the suppliers start asking the cash payment, is it a sign that the company in the stress because they are now demanding cash payments. Now, these symptoms will show in the balance sheet how these symptoms are reflected in the balance sheet in one balance sheet. Now, Nupur, share the balance sheet. Nupur, balance sheet को share करो.
हाँ जी सर.
First page balance sheet को show. Increase the size. थोड़ा size. Nupur, थोड़ा increase size. Yes. Bring down. Yes. Slide 2. Yes. So these two figures are there: equity share capitals and reserves and surplus. The company has paid up share capital of 5 crores and the loss is 37 crores. Figures are in lakh. But it shows there is negative net worth of the company. This symptom itself shows the company is under stress. Now, see the figure over debtors. The company has outstanding debtors. If you see, company has a receivable. Next, but where is the receivable? Nupur? Yes, this is the page receivable. If you see the trade receivables, the figures are 197 crores. 197 crores against last year's of 184 crore rupees. Now, see the next page. Next page, profit and loss. Show the profit and loss. Next page. Yes. If you see the balance sheet of the profit and loss, the turnover of the company has gone down from 394 crore to 51 crore rupees. The turnover has reduced substantially, but debtors have increased. But it shows there is ample stress debtors are not been realized, and the debtors are almost 4 times of the turnover. It shows the company is very much in the stress, unable to pay its liabilities. Now, how the auditor has dealt. If you simply show one figures, I will show the how the debtors are debt. Next, first on the balance sheet, the auditor has shown the debtors of 197 crore rupees. But he had not made even single penny provisions against the doubtful debts. If you worked out the aging of the debtors against the 51 crore rupees revenue, if the debtors are 197 crore rupees, you can imagine what kind of aging would the debtors would be there, and whether the provisionings are required or not, or what kind of qualifications are needed in the balance sheet. That's the whole issue. When the balance sheet comes to an IP, now what is the problem? How the problem starts?
Sir, this is a balance sheet 1 year prior to getting a company into IBC.
IBC.
Okay. So we are talking about exactly the real-time example of a balance sheet where the company has already gone into IBC, but you are representing the balance sheet 1 year before that.
Before that. Now the issue is why this balance sheet was important. In the normal course, when you audit any financial statements and company is healthy, nobody bothers about so much what kind of disclosures you give, what kind of things. Hardly regulatory agency look at the balance sheet of issues any notices. Only recently MCA has become a little bit active and start issuing some notices to the company secretaries for the people. But still regulatory mechanism is very weak as far as the healthy companies are concerned. But once the company is in the stress and it's likely to go to the under IBC insolvency process, the balance sheet is scrutinized by various regulatory agencies. First, RP, resolution professional, will scrutinize. He will, once he scrutinizes and finds something lying wrong in the balance sheet, he immediately shoots a letter to the auditor. Please explain what is there. Then, who scrutinizes? Then, if there is an RP finds some adverse and submits a complaint to MCA or NCLT, then other regulatory agencies come to the picture, the ED comes to the picture, then other agencies also, sometimes MCA also come to the picture, which issues the notices. Then whole type of problems are coming, and auditor also become a party. He has to explain his code of conduct. Therefore, disciplinary committee also comes to the picture. Therefore, auditor has to be very cautious once the company is under stress. Kindly move, the sound is coming. Somebody is speaking. Please move to. So, regulatory agencies look how the audit quality has been there, whether all disclosures required pursuant to Ind AS or AS have been made, what kind of compliances of the company set have been made in the balance sheet. So these are the issues where the auditor is submitting the reports. And after once a CARO report is said, earlier CARO report is entirely based on the facts. It is not the opinion. You have to analyze the facts, and reports is based on the fact only. And as RP, I as a RP look into the CARO reports, audit reports, and the balance sheet figures and disclosures made by the auditor in the balance sheet. And the few other issues, if we look into the balance sheet, the first issue is the going concern concept. Why this concept is necessary? So going concern is a fundamental. Nupur, show the slide. Going concern concept. Nupur, slide दिखाओ. Nupur.
Sir, I have a question in between. You were talking about 197 crore of trade receivable. How these were represented in the schedule, as in the auditor or the management had disclosed it, like I can see the turnover was 50 crore, 197 crore of debtors are coming. So was it being shown as more than 1 year? or it was not even disclosed in that manner?
They have not disclosed much.
Okay.
They have not disclosed much. That is why
And,
they not made
and
entire
the audit report you are saying was clean. There was no
yes,
mention
yes,
about it.
yes, yes, nothing but there. That's the problem.
Sure.
No material. What is the concept of preparation
No,
of
no,
financial-
no, 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 no. Just Chopra ji wanted to say something. I
Yes.
think. Chopra ji, आप mute है. अब वो पहले वाला ठीक था जो आपका. Continue, Pawan ji. I think Chopra ji, there's some. नहीं आ रही उनको आवाज.
Jatin ji, may I continue?
चोपड़ा जी की आवाज नहीं आ रही. He want to submit something, but it must be very much beneficial to all of us, being the insolvency professional. Chalo, please continue, sir.
The going concern is a fundamental principle in preparation of the financial statements. And the onus of determining the company is a going concern in the management. Management is responsible to make an assessment of the entity's ability to continue as a going concern and prepares the financial statement accordingly. An auditor's role is to collect the evidence and assess, yes, whatever management is saying is true. That is the only responsibility of the auditor. And if he finds that the company is not able to pay its liability in the next 12 months from the date of the balance sheet, as and when this liability becomes due, fall due, then auditor has to make a qualification in the audit reports. In this connection, standard of auditing 1570 is important, which has been issued by Institute of Chartered Accountant, which says what is the auditor's responsibilities. If the management is given the necessary disclosure in the financial statements, the auditor need to emphasize the same and refer this these statements, notes to the accounts in the audit report. And if there is no such disclosure, then auditor has to qualify the report. Because the law is very clear. In the CARO report is also there is a point specific says clause 19 of the CARO requires the auditor to report whether the company is capable of meeting its liabilities existing as on balance sheet date, as and when they fall due within the period of 1 year from balance sheet date. Reporting the issue must be made after properly evaluating risk and gathering evidence, ensuring that at least no default exists on the audit report date. The very important is that in the case of stress company, every evidence are available with the auditor. There must be default to the banks. There must be default to the creditors. Their terms of payments are not adhered. Then how the auditor can say that the company is going to pay its liability as and when fall due in the next 12 months? Certainly, auditor cannot escape responsibility is given the clean check and does not qualify or emphasize that there is materiality uncertainty about the company's remains as a going concern. That is very fundamental principle. And we find as a IP in most of the balance sheet, no qualification, no notes are given. That's the one first principle auditor has to take care. Now, second issue what we find in the balance sheet, realizable value of current asset including debtors, inventory, and loans and advances. How the management hide stress in the companies by inflating the value of the debtors, inventory, loans, and advances. If as a necessity, all they are part of the current assets. The current assets must be stated at their realizable value, except in the case of inventory, which are stated at realizable value or cost, whichever is lower. So anyhow, this current value of the current asset cannot exceed its realizable value. But as I show you the balance sheet, if the debtors are 197 crore rupees, can we say these amounts are realizable? And if the aging of the debtors is going more than 1 year, 1.5 years, or 2 years, then auditors say that these debtors are reliable. And if not reliable, how the auditors are saying the current assets have been stated at reliable value? That's the major issues where the issue stuck in 90% balance sheet or 95% balance. You will find this statement: the current assets are being stated at reliable value. Well, this reliable value are totally eroded and nothing reliable. All debtors have become debt and nothing reliable. That's the major issue, and therefore we say the auditors should make a cautious statement that these assets are reliable value or make the necessary provision in the balance sheet. Let's not hide the things which is visible from the balance sheet, face of the balance sheet also. And most of the balance sheet will find if we have not received the confirmatory letter from the debtors or loans and advances also. If nothing is available, then what is the basis of saying these are stated at the reliable value? That's the major issue. And IP is finding this is a major issue, and then these transactions are determined as fraudulent transactions later on by RP, and the reflection comes to the auditor also. The first principle, the second I said, is the reliable value, the current assets, including debtors, inventory, and inventory also. There are major issues in the inventory also. Inventories are always should be there. In most of the cases, inventories are not available or are overvalued. And the auditor had no documentary evidence to substantiate the same value. That's the major issue. The third is compliance of section 185, 186, and 188 of the Companies Act and disclosure of data party protection in statements. Why it is important? In the post of the balance sheet, the funds are siphoned by the management by making investments, loans, and advances to its related entities or other corporate, whether related or not, and they are not realized. They're outstanding for many years, and even interest are not provided or charged, or interest are waived off. Then where is the compliance of section 185, 186? And in the case of related party, 188. In most of the cases, there is no compliance at all. And when the related parties transaction, then 188 related party transaction says the transactions must be entered into an on arm length basis. That is a very important concept, on arm length basis. If there are group companies and materials are sold or purchased from with the group companies, or there are transactions for the supply of goods or services, then those transactions must be entered into on the arm length basis. And this is the one of the main source of diverting conduit or way of diverting the funds to the group companies by resorting to the related party transactions. And I believe is most of the transactions are determined by the RP during the CIRP process as fraudulent, undervalued transactions or fraudulent transactions. We'll come together what is the fraudulent transactions or undervalued transactions later. First, let's understand the issues in the balance sheet before the CIRP. This I'm talking about the balance sheet before the commencement of the CIRP, where these issues arise and how auditor has to. Now, next issue.
Pawanji, Chopra, you want to speak? Jatin, you are controlling.
Sir, you will have to unmute. Yeah, you are on mute, sir.
Chopra ji ke unmute karo, sir. Unmute karo. Ab ho gaya.
No, Pawanji was saying that he was talking about the arm's length transaction. The problem is not merely the arm's length transaction. That's the way I look at it. Because you have given an advance. Now, advance has been given at a particular rate of interest. and whatever is the rate of interest, that is the normal. But the advance is not coming back. Similarly, you have sold goods or you have purchased goods from someone. Generally, it is a sale of the goods because the money is not to come. Now, when you have sold the goods, you have sold it at the normal rates. That's not the problem. But the payment is not forthcoming from the related parties. The problem more than the arm's length is the non-recovery in time and evergreening of those loans or evergreening of those debts. That is the way I look at it. Arm's length is only one part. It can always be overcome. That I sell to somebody at 10 rupees per unit, I will sell to my related party at 10 rupees per unit. But I will not recover that particular amount because that party does not have even the funds to pay me that back. So arm's length is a minuscule thing basically when it comes to the problem. The main problem is the non-recovery because they have already diverted those funds somewhere else. That is
Yes.
Sir, I also want to ask you, you have raised a very valid point, and this is a practical problem. Sir, guide us from an auditor perspective as to if I am signing the balance sheet in such a situation, what is my responsibility considering we have already listed down all the related party transaction, but the money is not coming, then what is my responsibility as an auditor?
If you are under AS, in that case, you have to make sure that the provision based upon the aging of the debtors is to be created. And if you are on Ind AS, then expected credit loss model, the weightage will go high. If it is less than 6 months, more than 6 months, more than 1 year, more than 3 years, I think one very good thing which has happened with the revision of the Schedule 3 is now we are supposed to give the aging even beyond 3 years. So it is not merely less than 6 months, more than 6 months. No, it is less than 6 months, between 6 months to 1 year, 1 year to 2 years, 2 years to 3 years, and 3 years and above. अगर 3 साल से पैसा नहीं आ रहा तो फिर ECL में जो उसकी weightage है, it will be very high, and rather it can, because it's all unsecured, it can be treated at 100% provision also for that matter. So auditor की responsibility provisioning पे आएगी basically. अगर पैसा नहीं आ रहा, अगर उसने provisioning उसकी ठीक करवाई हुई है, then auditor has no liability. Let's be very clear about it. But if you have given an advance to a related party at arm's length, but that advance is not forthcoming, naturally, first thing is that this advance has to be impaired. And the second thing, which now NAFRA stage, which is the most difficult thing for us to make sure is, they say that you have to make sure that what is the end utilization of this advance. Now, for me to verify the end utilization of the advance or loan given to the subsidiary is a Herculean task, basically. For that, you have to take the certificate from the management and, of course, the other company that the loan which they had taken has been utilized for the purpose for which it was actually given. If that certificate is with you and the auditor of the other company has not raised any issue, I think to a very large extent I am safe.
Sure, sir. So, as we have the privilege of your presence, sir, I may ask you one more question related to this.
Yeah, please.
Sir, you mentioned about the evergreening, fairly understood about the credit loss and the money being given to the related parties. Sir, what will happen and how as an auditor I will verify if there is a smart promoter who is making the payment to one related party, but within 1 year he is replacing with the second party, and within next 24 months he is again replacing with the other party. I mean, how do we where do we stand as an auditor in such a situation? If there is a smart person?
But then that may not be evergreening of the same advance, because if the other party is able to repay you this particular sum, then it cannot constitute evergreening. Then you have no control over it, basically.
Absolutely.
Yeah. So that's, you see, what is more important in all such cases will be your documentation. If your documentation is strong, you will be able to defend yourself. If that documentation is not strong, then you are going to run into problems.
Understood, sir. So yeah,
I fully agree with Chopraji's observation. But in IP, as a RP, we normally find there is no replacement in RD, which is a loan replacement. That covered is current asset with the loans and advances are stated in the balance sheet as a current asset that has to be valued at the realizable value, and you have to make the provision. Now, after the Caro report, the auditor responsibility is very high, where he has to report the terms and conditions, whether loans have been repaid, if per the terms and condition, interest has been paid, there is no default. There are many issues in the Caro report, which I will discuss later on. Why? This is the factual information, and then you cannot disregard. The auditor has to disclose all those facts. Then let's discuss what is the point. But I said arm length transaction is related to supply, but loan advance is something different, which is covered under 185 because something limits are there. Board resolution should be there. Otherwise, this will try to hold up with no compliance at all.
Pawanji, I did not disagree with you. Please try to appreciate. I didn't disagree with you. I only said that arm's length is not constituting the main reason. The main reason is the non-recovery because of the diversion of the funds from the subsidiaries or from the associates or from the joint venture. Arm's length होनी चाहिए, इसमें कोई शक नहीं है. 185 की जो requirement है, that has to be complied with. But people generally comply with 185, but then siphon off the funds through the subsidiaries joint ventures. That is the point I was trying to make.
Absolutely.
I fully agree with Pranav Chopra ji. Only this arm length concept comes in the picture when the supply of goods and services are there between the group company. Nothing more. Loans advances.
No. Even in the case of the advances and loans, if you have been giving advances, if you are not giving advances to any other party, suppose I will talk this way. You give an advance to the other parties only for 3 months or for 6 months, but to this party you have given an advance for 1 year. And that too at a rate of interest which is much lower compared to what you have been charging to the others, then it is not arm's length. So it is not merely the supply of the goods and services which has to be at arm's length. Even the advances and loans have to be at arm's length, depending upon the terms and conditions of the repayment and the interest.
पवन जी, ये तीनों चीजें हो गई ना, लोन्स एंड एडवांसेस जो हम लोग हर रोज देख रहे हैं, प्लस we are looking in every balance sheets, whatever we are doing.
Anyhow, now what the report, the other issue is the disclosure of the related party transactions in the balance sheet. The AS, there is an AS requirement also, and most of the balance sheet we observe, the auditors are not very meticulous in showing the related party transaction outstanding in the disclosures. That was the major issue. And sometimes their secretarial department of the company may be concrete because they are not showing the entire facts to the auditor, and auditors are not able to detect whether they are the related party or not. But sometimes we find during the insolvency process, there are many entities which can be categorized as related party, but have not been disclosed as a part of the disclosure. So this is a very.
इसमें पवन जी मैं एक बात बोलूँगा. If the auditor is smart, he will take a certificate from the company secretary which are the related parties, because he cannot identify which are the related parties. Related parties has to be identified by the company secretary basically. अगर वो company secretary से certificate लेता है, इसमें in most of the times the basic responsibility for determining what are related parties lies with the company secretary. So अगर उससे certificate लिया हुआ और थोड़ा सा अपना दिमाग लगाता है कि भाई ये वाकई में कोई उसका बेटा, उसकी वाइफ, उसका कोई भाई तो नहीं है, in that case the auditor can play safe in this.
I think
I
very
fully
valid
agree.
point raised. Very valid point raised, sir. What is happening in and we look into this on day in day out basis. I think most of the chartered accountants are owning this responsibility. They should actually take the certificate from the company secretary. That's a very valid point.
And the next issue comes the report on adequacy of internal financial controls. In most of the cases, we find the CS are issuing the report on internal financial control as a routine, even if there is a stress in the companies. And in most of the cases, when there is stress in the companies, you will always find inadequacy of internal control system. So one has to very draft the report meticulously when there is stress in the companies, by totally ensuring that there should not be any flaw in the internal control systems or breakdown in the systems. Otherwise, if the systems are working correctly, then your balance sheet will or financial statement will come adequately automatically, because the internal financial control is related to financial preparation of financial statement only. if
तो
the
ये
sale,
जो ये जो ICFR की प्रॉब्लम है ना सर, this is
हाँ जी,
with regard to only the reporting part,
Yes.
reporting of the financial transactions. ये जरूरी नहीं है कि अगर एक लॉस मेकिंग कंपनी है क्या उसकी सारी नेटवर्क एरोड हो गई हो कि वहां पे इंटरनल कंट्रोल्स ठीक नहीं थे. और देखिए मार्केट प्राइसेस हैव कम डाउन, द सेल प्राइसेस हैव कम डाउन, your sale controls are perfect, your purchase controls are perfect, yet you are incurring losses. It is very much possible that despite having the best of the control system, you may incur the losses. But yes, what is more important when we talk of ICFR is कि आपकी डेटर्स की रिपोर्टिंग ठीक हो, आपके क्रेडिटर्स की रिपोर्टिंग ठीक हो, आपकी फिक्स्ड एसेट की रिपोर्टिंग ठीक हो, आपके कैपिटल वर्क इन प्रोग्रेस की रिपोर्टिंग ठीक हो, आपके इन्वेस्टमेंट्स की रिपोर्टिंग ठीक हो, उनकी इनकम की रिपोर्टिंग ठीक हो, रेवेन्यू रिकॉग्निशन का सिस्टम ठीक हो. But simply because the company is running into losses, it does not mean that they don't have the adequate internal controls.
I agree, sir. But what point we are making is, in most of the cases, because it's a stress company, there is tendency. That is why I'm saying this point. There is a tendency. This is not always. This is not, no rule in stress company. There is a weak in the financial control. But mostly, when the disclosures are not there, it means system is weak. That's what we are saying. Now, next, the CARO report. There are many reports, but there are two particular points in the CARO. 2-3 particular points. As a RP, we look into two things. One is the point number 1, fixed asset register. When any company comes in the insolvency process, CRP process, first item of agenda of the RP is to take the possession of the company, physical control of the company. And for taking the physical control of the company, he needs the fixed register. At least we have not come across during the last 4 years any company which are having the fixed register, and the auditors have routinely said the fixed register are being maintained. There is an adequate system, a periodical system of physical verification of the assets, and assets are reconciled, and nothing and material discrepancies has been dealt. This is the routine statement the auditor make in the CARO report, but in none of the cases fixed registers are available. And we approach the auditor also. If you have mentioned this in a report, issue the CARO report, where is the fixed register? Have you got any copy? Have you record of any physical verification of the assets? The reply is not forthcoming. So we should be very careful, and we draft the report cautiously when we give our opinion or the statement on this CARO report. Same is the report on the inventory. Inventory also says the management has the system of physical verification of the inventory, and the shortage of inventory, material discrepancy, have dealt with the adequately the book. So this is the statement with the auditor give reply. And when the companies come under the IBC process, no records, no physical inventory, count sheet or physical verification sheets are available, and in many cases inventories are found missing. And when we issue a write letter or email to the auditor, they please give the confirmation where is the inventory, whether you have the physical verification system, whether you have got any record of the company has verified the physically in the last 1 year, 1.5 years. No reply is forthcoming. That is it means the routine CARO reports are prepared in routine without looking to the facts. That is the important issues.
No, to be this case, we should take the comment of Chopra ji also, because everywhere we have found no record is available of fixed assets, no inspection report is available. I think we should take the expert advice what to do as an IP. We can only file the fraudulent report or whatever under the provisions are allowed. Chopra ji, you are there. Anyway, later on we'll take later on. Please continue. I'm sorry.
Now there is other requirements also, CARO, regarding the related party section 177. Again, the clause 30. There is a very detailed disclosure requirements in the CARO reports about the loans and advances, whether the loans has been repaid on time, and for the terms whether repayment schedule has been specified or not. If the specified, whether you are getting the repayment in accordance with whether loan or most important thing, what the CARO report says, these loans and advances are not prejudicial to the interest of the company. That is a very tricky statement, which question has been asked. If the loan interest rate is not commensurate, the repayment terms are not in line, whether your requirements are there. So you are in the stress and you are giving the loans with a long-term basis. Not the terms are not prejudicial to the interest rate and the interest of the company. So you are paying the independent interest, everything you are paying for 13%, 14% interest, and then you are charging 8%, 9%. If the terms are not prejudicial to the interest of the company. So these are factual information, and the auditors has to look at the things and give the statement very cautiously on this statement. Carry report requirement about the loans and advances is a very important. Otherwise, so in CRP, when the RP look at the statement, then it becomes a very tricky situation. Auditor will not find any answer for this statement in the audited report. Now, why these issues are important? Now, question, we have discussed many issues. How RP look into the system and why the statement RP look into the things in this balance sheet. The issue is under IBC, RP had to determine preferential transactions, undervalued transactions, extraordinary transactions, and fraudulent transactions. And if the RP determine any transactions at fraudulent transactions, preferential transactions, or undervalued transactions, then definitely it affects credibility of the financial statements also. There may be financial transaction, preferential transaction may not affect the auditor because he had no role. If somebody had repaid the loan, he cannot do much. But as far the fraudulent transactions are concerned, or undervalued transactions are find out, then certainly it affects credibility of the financial statements. That's the other issues. And most of the cases, you will hardly find any CRP case where the auditor has not filed or determined fraudulent transactions or undervalued transactions. You may not find very routinely in very few cases. The problem is RP not able to get concrete evidence to substantiate argument that the transactions are undervalued transactions. Suppose if some goods have been sold today at even if the undervalued price, it will be very difficult for the RP to substantiate that the transactions were not entered into the arm's length basis because it needs substantiation, and RP find difficult because undervalued transactions we can get away, but for fraudulent transactions the law is very wide. Any transaction, most of the if there's something fishy, then it can be categorized as a fraudulent transactions, and it certainly reflects on the audit quality also. That is our view as a RP. So these are the major challenges during the CRP. And before the CRP process starts, and it's a good area of practice also if you are adhering your auditing standards, disclosure requirement as per the Ind AS or AS, that certainly your challenge risks are minimized and nobody can touch upon the auditors. If the disclosures are there or adequate provisions are made there, then certainly there will be always opinion. The balance sheet is based on the opinion also, but opinion 10-20% plus minus can be there. But if your disclosures are there, your sound basis of making the provision, then certainly there is nothing on the auditor's part, and he can explain this transaction. So that our issue is a good area of practice also, provided you audit the balance sheet professionally. That our submission. And if you work, then definitely a lot of business will come for the stress companies also to the auditors. Now, how to present this loss? Now, we are talking about the post restructuring. I am not touching about during the CRP process balance sheet because no new things arise during the CRP process, because the balance sheets are handled because after the commencement of the CRP process, management of the company is best with the resolution professionals. He arranged the audit of the financial statements and he gives free hand to the auditor to make any kind of disclosure in the financial statement, make any kind of provisioning in the balance sheet statement, though there is no major challenge during the CRP process. One can go ahead, no issue, he can qualify the balance sheet, RP not bothered because he's not, what is their legacy, he has to follow the legacy, nothing more there. But post CRP, the few challenges, and this is a new avenues for the auditor, for a young chartered accountant to practice. Once a resolution plan is approved by NCLT, there are terms and conditions given in the resolution plan, how much liabilities new management or new resolution applicant will take over. Now, here to give effect in the balance sheet, the terms of the resolution plan. The liabilities are stated at the value proposed to be assumed by the resolution applicant, irrespective of the liability existing in the pre-CIRP stage. After the resolution of the case, in the resolution plan, amount of the liabilities are given, at what value new RA will take over. So this liability has to be stated accordingly. But representation of the liability or restructuring of the liability is not a challenge, because this amount is given the resolution plan. The major challenge is in the restructuring of the assets. How? Now, assets can be classified in two categories, like non-current assets, which one can be non-current assets, investments, or fixed assets, plant and machinery, land also. The issue is how to restructure those assets. Certainly, the value WDV is not increased. Normally, WDV of the assets are not increased, because if we increase the WDV, then many issues, challenges there. It may be termed as revaluation of the assets, and then it will affect depreciation in the future and many things there. Normally, revaluations are not done on the higher side, but sometimes the fixed assets are written off. If the assets are not available or realization value of the assets is likely to go down, then you have to provide the additional depreciation on the assets. Write down impairment loss. You have to write down the impairment loss in the fixed assets and bring down the assets value, WDV assets, in accordance with the realizable value. Now, same is true for the current assets also. The challenge is how to value debtors, inventory, loans and advances, etc. Here, one has to rely on the wisdom of the management also. Management has to evaluate how much money they can realize from the debtor. Subsequent event, if the balance sheet date is after 6 months, something, or it can rely upon how much amount has been realized during the last 6 months. So that can be a yardstick to value the debtors, inventory, loans and advances, security deposits, etc. That can be yardstick. But once we value these assets, then there are number of income tax provisions also, and the future, it affects the future also. Suppose you write down the debtors to a large extent, or make the provision to a large extent, then you will get, but income tax, there are many income tax provisions, because debtors provisions are not allowed. So your balance sheet will go down, but later on, if you realize, then there are tax issues. Same with the tax, the number of sections are there which interplay why taxation is concerned. Section 28, subsection 4, write back of term loan liability is taxable. This is the major issues. Many times the resolution applicant approach RP, especially when there is a large accumulated losses. They want to leverage the carry forward losses, whether they can take the advantage of carry forward losses and give some value in the resolution plan for the same. And as and when anybody approach, my simple answer is, please don't give any value, which is a very tricky issue. How much value you will get, how much value carry forward losses you will get, nobody knows today. Because of 2-3 simple reasons. Firstly, balance sheet losses have no meaning at all. You need the losses which have been allowed under the Income Tax Act as per the assessment orders. First, you need their figures. Then you do not know what balance carry forward loss will remain there after the completion of the remaining assessment also. You may get the return also, but a true picture will be known after the completion of the assessment also. This is also the risk. Then, what is a carry forward loss will be available only after the restructuring of the balance sheet. Once you do restructuring of the balance sheet, then if you suppose you write back a liability of the term loan, as per the section 28(4), write back of term liability now taxable. Once there was a Mahindra case, Supreme Court judgment, which said write off the term loan is not taxable. But in the last budget, there is an amendment in the budgetary provision which says the write back of the loan is now taxable. Now, there are many provisions we have seen. Some item was allowable on cash basis. Now, if you write off those liabilities which are always allowed under Income Tax Act on cash basis, this write-off has no meaning at all. So you have to analyze each and every item, how its effect will be on your tax liability. Suppose after the restructuring of balance sheet, there is a gain. Why gain? Your liabilities will go down substantially. You are not taken a very high haircut, and you don't want to give the impairment loss in the balance sheet for the assets. Then there is a income. In the balance sheet, there is income. Then before you pay the tax, first you have to adjust the carry forward losses. And only after the adjustment carry forward, you will get the net carry forward losses, but will be available in the future. So these figures are totally uncertain. You cannot rely on the figures. This figure will be known only after the restructuring of balance sheet. So that is why I just advise people who ask this question, whatever benefit you get, please treat it as a bonus. And please don't give any value for this carry forward losses. There are a number of sections.
Sir, we have a question in between.
Yes, Jatin.
There is a question from Dinesh ji. He's asking, can there be a forensic audit and insolvency proceeding simultaneously?
Once the CIRP system starts, then RP comes to the picture, and the banks who initiated the fraudulent activities, this one as forensic audit, in no more remain a redundant exercise. Because ultimately, what RP has to file the report before the NCLT about the determination of the transactions. And on that basis, the promoters will be called on. The liability, because that at that time we have not seen anywhere where after the commencement of CRP, the COC members or banks ask or appoint any new forensic auditor. If they want to appoint, then they ask RP to appoint forensic audit. There cannot be a separate forensic audit.
Dinesh, this answers your question. You are on mute.
I got it, sir. Yes, I got it. Yes. Very clear answer. Thank you. I have another meeting at 4 o'clock. I may leave.
Sure, sir. Sure, no problem.
Pawanji, I have one question. My question is pure and simple. Why CI, even RPs don't appoint tough auditors?
Please repeat your question, sir. It's not fully audited.
I'm saying, why even RPs don't appoint tough auditors? Companies don't appoint tough auditors, I can make out. Even RPs don't appoint tough auditors.
Sir, should I give the reply to this? I will reply, because RP is to select and invite the quotations for the appointment, for the selection of the forensic auditors. And in that process, it is to be placed before the COC, the financial institutions, who has to practically approve the appointment as decided, as chosen by.
But with sir, that would mean neither the COC nor RP want to appoint the tough auditors.
No. We have appointed in 2 cases. We have appointed.
I can tell you that neither the bankers nor the RPs want to appoint the tough auditors. Practical experience.
I agree with you. It depends on number of issues. It depends on about the fees also. If KPMG asks for 25 lakhs rupees, GSA asks for 20 lakhs rupees, and other forensic auditor who has done at least 20 cases.
I wish GSA would have demanded 20 lakh rupees, but GSA does not have the audits primarily because of being tough. I'm not seeking the audit there, but I'm
no. It is it is not the point.
I'm telling you, generally, RPs and COCs avoid any kind of tough audit. Why? I don't know, because probably bankers are scared that their accountability would be fixed.
Yes, that is absolutely true, sir.
And somewhere some RPs have their own interest also.
No, there is no interest. My Pawan will reply to this on this. Where is the RP's
Yes.
interest?
No. I will reply, Chopraji. But there are two questions. RP's responsibility is given on the determination of the transactions under section 43, 45, 50, and 66. Where the limitation period under 43, limitation period is 2 years for the related party and non-related party is 1 year. Same in the undervalued transaction. Only in the case of section 66, there is no limitation period. That's the one thing. So RP. As per the IBPI pronouncement or in the judgment, in the 1 or 2 case, the IBPI stated that RP cannot appoint or cannot pay the fees of the forensic auditor. Let the COC should decide on this matter. So this the prerogative has been given to COC to decide whether they want the forensic auditor and define the scope of the work. In one case, they said if the COC members want the forensic audit, let them pay the fees. Let them pay the fees. This cannot become the part of the CIRP cost. This is one issue. Second, RP response is very limited to determine the transaction 43, 45, etc. Therefore, auditor cannot travel beyond a point. The third issue is on the fees also. When the RP has a limitation because he has the liberty to appoint anyone as the transaction auditor. But the fees is approved by the COC. When the COC says the fees should not exceed 1 lakh rupees, 1.5 lakh rupees, what to do? If you appoint any big auditor, nobody will charge less than 10 lakh, 15 lakh rupees. In 1 lakh rupees, what can be the scope of work? That's the limited issues. In the same thing, we find the valuation also. In the SFA valuation, COC generally allow 20 to 25,000 rupees fees only. What kind of valuation you can expect at a fees of 25,000 rupees? This is the issue because the COC member, the third issues. In the CRP cases, funds are not available with the RP. He totally depends on the COC members. COC member does not come forward to contribute. In very few cases, they come and finance the CRP cost. Then the fees bills come, how to settle those fees. That is also becomes issues.
I do agree with you partially, but that only shows that when you give peanuts, you will get monkeys only, and it means that the audit is flawed. So I will not go beyond this because I will only like to say that both COC, RP is constrained, and COC does not want it to happen that way, and the audit process remains flawed, and there is no quality audit which takes place after the process of CIRP starts.
Sir, in one of the case, my team has worked very hard, total diversion. And we have filed a particular case with NCLT as our determination report of 206 crore rupees. And COC members were also supporting in that particular case. Please understand. But again, it is pending with the NCLT, sir. Again, it is pending with the NCLT. Nothing is happening.
So,
Sir, I can inform you.
Because it may seem as if I am trying to propagate something.
No, yaar. Chopra ji, we are enjoying your views. We are enjoying your views.
I'm only trying to find out or ascertain where lies the problem. Because actually, if you pay 80,000, 1,30,000, you can't get an auditor for that. Basically, that's pay. And unfortunately, this is the level of the fee which is being paid to the auditors. And then we all blame the auditors later on that the auditors are not performing their jobs. So I will like to stop here because after another 10 minutes, I have to attend some Kriya ceremony. Basically, I am in the car right now. So what I am trying to say is that somewhere it pains you because a process which was started with a lot of fanfare again has run into some kind of problem for certain reasons.
Very valid point.
I will point out one, Chopra ji, I will make one observation here. If you see the track record of the realization from the entire recovery has been made so far from these transactions. There is hardly 9,000 something crore rupees has been received during the last 5-6 years. And out of this 9,000 rupees, 4,500 crores has been received in one JP transaction only. The recovery rate is only 102% only. This report is of the IBPI only. Because of this low recovery rates, the banks or COC members are totally discouraged. They say, even if we do this forensic audit, file the report within what is the recovery? Why do we spend this money? That's the entire issue.
But there is one big
RP also
problem.
discourages.
So
RP
that
also
would mean that there is something wrong at the NCLT level.
Yes,
sir.
NCLT level and
Bureaucracy, politician, NCLT,
yes.
they all gang up. So that's
Sir,
all I can say. Fine.
Sir, RP cannot cannot approach the regulatory agencies. RP cannot approach the ED or CBI. It is only on the basis of the NCLT or the banks. RP's duty is to complete the process in a specified period. But again, there are a number of problems which are coming, and we are informing to IBPI.
Let's move on. I didn't want to hold on to the discussion. Let's move on.
Okay. Thank you very much, sir.
No, sir, very valid.
I am sealed today.
Sir, very valid point raised. The overall NCLT process is a lot of renovation and the innovation also.
Jatin, can I take 1 minute in between?
Yes, Saniza, follow.
Sir, I say that now this whole process is a legalized way to give a big haircut to the banks. Make sure that people who are interested parties make kill out of it and kill the banks simultaneously. It needs a huge reform.
Arun, you have put it in a very subtle manner. I say it's a legalized form of corruption.
Yes, sir. It's a legalized form of corruption.
No, we need certain improvement. अगर हमारे अरुण जी होते तो शायद बहुत कुछ हो जाता. Anyway, it is the process. Who has brought this act? We know how much pain he has taken. So it's all is before us. Anyway, please. Thank you very much, Chopra ji. Please, Pawan ji, please continue.
Now, let's conclude because we are already past 4 scheduled time. So there are number of sections of Income Tax Act which interpret.
I'm signing off right now. Thank you very much.
Okay, sir. Thank you.
Thank you.
Bye.
Thanks.
Thank you, sir. Thank you.
There are number of sections of the Income Tax Act with interplay about the taxation liability on the restructuring of the balance sheet. The section 24, subsection 4, write back of term loan liability, which now become taxable. Section 43B, any write back of certain outstanding liabilities which are allowable on payment basis in the books of accounts shall not create any taxable liability. Section 50, impairment loss on depreciable assets may result in additional depreciation in case there is complete extinguishment of the block due to such impairment. And for section 41, subsection 1, write back of suppliers outstanding salaries, etc., will result in taxable income. Section 9, this is a special section has been introduced because the IBC will say if there is change in the shareholding due to takeover of the new resolution applicant of the company, then carry forward losses shall be allowed. Then accordingly, there is change in the section 150 JB also. Normally, cash losses or depreciation which have lower is allowed in that under section 150 JB. But in the case of carry forward unabsorbed depreciation which are less now allowed, not the cases you can allow anything. There is change in this section also. But as for the restructuring of the balance sheet concern, normally IBC or NCLT allows that there will be no tax liability on the restructuring of the balance sheet pursuant to the approval of the resolution plan. Normally allows, but surprisingly, there is no provision under Income Tax Act related thereto. But IBC allowed because they say the law says why this benefit is allowed, because the law says, IBC says that new resolution applicant should start at a clean slate. This is the principle Supreme Court has repeatedly said, and because of this reason only, no tax liabilities are given on restructuring of the balance sheet, which is completely waived off. But our suggestion to the Income Tax Authority also if the Supreme Court is saying NCLT is approving this benefit routinely, let's make some amendment in the Income Tax Act so that everybody is aware about this provision and they know hassle later on before the income tax authority. The last point I would like to mention, after the restructuring of the balance sheet, all past liabilities are extinct. It means Income Tax Department or GST departments cannot issue any notices for the past assessment years, whether they assess the demand or not assess the demand, or pending assessments are there, or reopening of the assessment years. In no cases, Income Tax Department can issue. These are based on the judgments of the Supreme Court, and High Courts of Delhi has recently also given 2-3 judgments on the subject. If the resolution plan has been approved, the Income Tax Department or GST department cannot create a new liability relating to the earlier years. That we have to give. That is why we said we should not be scared away. And the last, how the auditor can take the benefit, particularly new young chartered account professionals. IBC has created new avenues for the chartered account. Also, the first stage, the audit of the stress companies. If you are professionally qualified, you have the knowledge and wisdom, you can do a lot of work in the audit of the stress companies, both pre-CRP and post-CRP also, because this considerable knowledge is required in the audit of the balance sheet before the commencement of CRP as well as post-CRP. Then other avenues also in the IBC process, transaction audit, where the RP appoint transaction auditor to help him determination of the preferential transaction, undervalued transactions, fraudulent transactions. And then there are other small things which RP need the services of chartered accountants. Sometimes he takes the help of the auditor or chartered accountant in claim verifications also. Then routine compliances, because the CRP process takes about 9 months or maybe sometimes 1 year, sometimes it goes for 2 years also. So during this process, RP needs the services of the professionals to make compliances. The compliance includes filing of the TDS return, filing of the balance sheets, then other filing of the even company secretary also get the work by way of annual filing or various filing of the forms with the MCA website. So these are the avenues where the young professional can look for if they totally align or something with the resolution professionals which give these services to the appoint professionals for these services. Any question, then I can answer those questions, Jatin.
Yeah. Thank you. Thank you, Pawanji. So just to recap on the opportunity sides, which is available to the chartered accountants, I think there are a lot of opportunities available in the insolvency law, and there are a lot of opportunities to work with the insolvency professional for the chartered accountants. One is definitely the transaction audit. Second is the preparation of financial statements. When the company gets into the insolvency, it's a normal tendency that the chartered accountants and the existing accounts team, they leave. So the insolvency professional requires a lot of support from the external chartered accountants to prepare the financial statements. And then, of course, on the filings with the ROC, MCA, and then transaction audit and all other things. So as I understand, there are a lot of opportunities and the support required by the insolvency professional from the chartered accountant side. So you want to add anything, Pawanji?
Thank you, Jatinji. I have nothing to add.
Yeah, we have got a couple of questions. One of these questions we have already addressed in between. There is one question from Jitenderji. Suppose we are auditing the accounts of a company going through the CIRP process. I have requested provisions for doubtful debtors, security, loans, and advances. However, management has denied that request, stating that no provisions can be made because the outstanding balances are opening balances from before the commencement of CIRP process. So advise how this should be taken care of.
Jatinji, during the CRP process, the management of the company is vested with the resolution professionals. And therefore, there is no role of the ex-directors. Their powers are suspended. So if auditor can always approach to the RP. If RP agrees, then he can make the provisions. There is no restriction at all. If the balances are outstanding, yes, there is no restriction. he can make the provisions and do the balance sheet accordingly. And in the case of during CIRP period, let's be very clear, the balance sheets are approved by the RP only, and RP signs the balance sheet as a CO. And sometimes he asks the auditor directors also to sign the balance sheet in individual capacity, and the balance sheet are not approved by the board of directors because his powers are suspended. Therefore, RP auditor is not under any obligation to take the instruction from the directors on the subject.
Oh, thank you very much, Pawanji.
I think very well-defined answer. Jitendra ji, is it answered, or you want to ask any further thing? Yeah, thank you. Done. I think, thank you so much, sir. It was wonderful session, and with the presence of Mr. M.L. Vij and Mr. Amarjit Chopra and Mr. Arun Seni, I think it became more interesting with a lot of brainstorming and a lot of other experienced ideas flowing from different angles. I think this was a learning experience for all of us, and thank you so much for joining us in this session.
Thank you. This is my privilege to be here today with so much my professional colleagues and sharing my thought with them.